Hi, Greg Weldon here with WeldonLIVE for Thursday, May 12th. Now, if you are a regular listener, reader, viewer, you know that today is a big day because, well, really today meaning Wednesday. We're already now into Thursday Asian morning as I start to produce this. But Wednesday was a big day. Why? April CPI data, something that I've been talking about since last end of August into September through October. All right, just printed at 4.2. Not many people out there were saying a four handle. I was. And what's funny is I caught a lot of slack for it. You know, like that's insane and this is going to be transitory. Inflation never comes and whole 9 yards and so on and so forth. Some of the special aggregate indexes, which the BLS publishes every month, which we look at every month, are off the charts. 12 point something, 14 point something, 9 point something, 7 point something, a lot of them. All right. And in that vein, I had brought back in August of last year my Waiting for Godot theme. But in the past, the Waiting for Godot theme was because we were waiting for Godot. And Godot was always inflation. And the original play and the theme I used for many, many years previously was Godot never shows up. So the Fed sits around and talks and theorizes and this, that, and the other thing. But inflation is Godot. And it doesn't show. But then August of last year, as I said, 2020, offering the alternative ending to the great play and saying, in fact, in this version, the 2021 version, you will see Godot show up at the end, changing everything, okay? And in this case, let me introduce now to the stage the great, and always missing until now, Godot. But there's really so much more because there's so much more going on, all right? We talked about bonds being worthless. Okay, we talked about inflation was coming and to see a four handle. We talked about the time frame where I have seen specifically in 2007 and 8, and even more precisely in 1987. I was trading back then, man. It was the same thing. We were short bonds, got short equities at the exact right inflection point. This is a replay of that to me so much. It really has eerie similarities and, of course, major, major differences. It's nothing like 1987 in many, many ways, most of which are negative. But the setup, the timeline, the situation with the bond market, how it drove stocks, how kind of this all lays out to where I started talking about normally October is when you see these declines, but how about with the bond market being the one that started its big decline, August, September, October, that you have an October in May 2021 stock market sell-off, and this would be in the realization that this inflation is different. All right, so different. It's not transitory. It's not 2007 and 8 when crude oil went to $150 a barrel and everything broke, all hell broke loose in terms of energy prices, and the flow through to other prices took place, and all of a sudden you had a real estate bubble that popped, and it was a double whammy. Today's inflation is so different. This is way more embedded. It's going to take a lot more time to work through. It's not transitory. Will it? Some of it is. Will eventually will be when the deflation impact of inflation on the consumer takes hold. And, of course, all of this we say all the time could be circumvented by a decline in asset prices that brings about that deflation, that stops this inflation. But that may not stop this inflation. What if it's the ultimate stagflation scenario? I mean, because this is supply chain disruptions. This is some of these things are transitory, like not enough truck drivers, like port congestion. Other of these things are not, in terms of some of the dynamics around, really secular changes in the supply chain. All right, and the dynamic that we've seen, all right, through COVID and even after, where vendors have and manufacturers have specifically told the Fed in all the regional surveys and all the special questions in the Beige Book, we see this all the time in the Beige Book, that they have and will continue to pay more for the product they need in order to meet the final demand of their customers. All right, that's not transitory. And what's not transitory around this too, is the primary thing that is held back Godot from showing up, i.e. inflation from, being real and being above target and being 4%, all right, is that you've had this, price discovery technology dating back to the 90s that is still kind of maintained with the advent of online shopping. Brought a whole nother round of this price discovery where it's competition to maintain market share, which keeps, a cap on prices. All right, a cap on labor costs you've also had. You've had offshore production and cheapened labor there too. All right, that environment, you had no pricing power because you just go along and buy the next cheapest product. The pandemic changed the whole psychology around this, where consumers all of a sudden realize we've taken this stuff for granted. Just toilet paper, just food, just vegetables, just some of these things that, they don't even think about. All of a sudden you can't get. Well, guess what? That's a real hardcore shift in psychology where people will be willing to pay more to ensure that they have the necessary inventories and supplies of the things they need. And to the degree the things they want when they can't get stuff like furniture. Try buying furniture now. I had a conversation with one of my friends yesterday who ordered new golf clubs. Try finding golf clubs right now. I mean, I'm still waiting on my Titleist bag. Although the pro at the shop up here tells me get it for me in a few weeks, I've been waiting since December from the PGA, Superstore to get a $150 Titleist carry bag. So this, you realize availability of supply is more important than how much you have to pay to get it. Plus, you're sitting on this ton of savings. You feel a little more, at least refreshed, some people. And the people at the lower end of the spectrum, of course, according to the New York Fed survey that we dissected months ago, this was the January survey, if I remember correctly, that first showed us households expected 1% income growth and, as high as 6% inflation. And you wonder why they're not going to spend as much. All right. You wonder why they'd rather pay down some credit here, which is a good thing longer term, but a bad thing near term for the economy that's built on credit, a 50-year credit bubble. All right. So in that time frame, this we know, and again through the Fed Beige Book and through all the regional surveys, what firms and manufacturers and vendors and everyone has told us, we will pass through. You have pricing power, you have pass through. We haven't had that. All right. And we have a consumer that's willing to pay more and frankly can afford it, at least for a while, at least some consumers, the most, not those at the bottom end, which of course only sows this, the seeds for future social unrest. We talk about this all the time. All of this is polarization, everything you see going on. Now, what happened the last time inflation went from below 4 to above 4? Well, that was we have the highest rate right now since September 2008. But the last time we went from below 4 to above 4 was, of course, months before that in May of 2008. Over the next 10 months, the S&P 500 was down 53.7%. And it was only QE1 and St. Patty's Day monetary massacre in 2009 that saved the day. All right. You think there's another trillions of dollars a package to save the stock market now with Joe Biden as president? Oh, I don't know about that. And in terms of the next, what is our next, kind of mutation of waiting for Godot? Yeah, I used to work for the Westies. I was a bodyguard and a driver back in the mid-'80s. So forget about it, okay? I come from the boroughs of Manhattan, from New York City, I'm telling you, all right? And Godot meets Tony Soprano. Might have to be the next sequel because, you're talking about getting into the cement business. I mean, cement's pretty expensive nowadays. No, I'm only kidding. But from that perspective, let's please, right now, where you stand, and welcome to the stage, the Great Godot. Godot is in the house. Hi, this is Greg Weldon, and thanks for coming and checking out our preview of Thursday's Weldon Live, in which I dissected the CPI numbers, 4.2% headline rate, which was not a surprise to regular viewers, listeners, or readers of Weldon Live, although it did shock. Certainly the pop media was all over this, and if you really look at the impact on the markets, it's pretty interesting as we head into this week. And if you want the full video, if you want the chart pack, and if you want to see tomorrow's, Tuesday, since it's Monday morning, follow-up, which I've already sliced and diced the retail sales data from Friday. I've already dug into the import price index data from Friday, and the import price index is the transitory factor, quote-unquote, that the Fed always talks about. And it's at 10.6% year-over-year rate of inflation. Within CPI, we had multiple special aggregates indexes in double digits, as high as 14% year-over-year. And when you look at this and put it all together, I mean, it's something really interesting to me as we go forward, where people think that inflation is going to be short-lived. And the numbers tell a totally different story. And you're going to want to have this in your pocket when you move forward. Weldon Live is the research that has paid for itself for 22 consecutive years. So if you want this package here, go to the website and sign up, or email us directly at sales@weldononline.com.